Welcome to the Cryptoteacher. And guys, I come back with that second video just to make you think. And this one is going to definitely make you think. We had Jerome Powell on CNBC with the IMF. He speaks about inflation. He also talks about the new economy. We're not going back to the old economy. We're going to technology. He said he spoke with the corporations. They're looking at bringing in technology and hiring fewer people. But the fact is, the most important thing in this video he talked about was inflation. We know the back half of this year, starting in July, we're going to start seeing that inflation. We know the only tool they have is to raise interest rates. Can they raise interest rates, people? No, they cannot. Not when you printed 20% of all currency in existence in 1 year, and that was 2020. And we keep printing. Right now, they're trying to manipulate yields just to keep the stock market where it's at. So guys, when you see inflation, talks of tapering the balance sheet, raising interest rates, what are they doing, guys? That's right, causing a problem, waiting for the reaction and running in with the solution. We know CBDCs are illegal in the United States and in Europe, so they have to cause a problem, bring the United States to its knees. We see it in the supply chain. We see all these people out of work. We see the ending. Those who want to see the truth, because remember, when it comes to the Cryptoteacher, I bring you the truth. Yes, the truth hurts, but what does it do? It sets you free. And once you learn the truth, you learn that when it comes to the New World Order, everything is planned out. Enjoy the rest of the video.
The speed of recoveries, they're not doing as much on the fiscal front as we are here in the United States. Does that matter for how fast you're going to start the exit strategy, start talking about tapering and the paths from normalization?
Well, so what we've said about our asset purchases is that they would continue at the current pace until we see substantial further progress toward our goals. And that will really mean actual progress. We're not looking at forecasts for this purpose. We're looking at actual progress toward our goals. So we'll be able to measure that. That's inflation. It's also the indicators of maximum employment. What was so unusual about this event, this pandemic event, was that it hit companies that were in the service industries that faced the public with a lot of public interaction. And the people who lost their jobs to the biggest extent were relatively low-paid service workers in travel, leisure, hotels, restaurants, and things like that. Those people tend to skew towards minorities, towards women. They tend to be lower paid and have less in the way of wealth to fall back on. So they bore just a very large portion of the burden. As I mentioned, the unemployment rate among the bottom quartile of earners is now still 20%, whereas at the higher end, the labor market has virtually recovered, but not for people in the bottom 20%. So we've been very concerned about this from the beginning. And it amounts to 9 or 10 million people, depending on how you count it, who were working in February of 2020 and who are now unemployed. So they were in the workforce. They clearly want to be working, but they're not. And we will not forget those people, and we'll provide the economy the support that it needs until that job is done. The real concern, though, is that longer-term unemployment can allow people's skills to atrophy, their connections to the labor market to dwindle, and they have a hard time getting back to work. Also, it's important to remember we're not going back to the same economy. This will be a different economy. And one of the things we hear from companies is that they've spent a lot of time since the pandemic arrived looking at ways to have more effective technology and perhaps fewer people. So you're going to see some of that in these public-facing jobs. So there will be millions of people who have a hard time finding their way back into the workforce and recovering the lives that they had just a year ago. And, I think it would be appropriate for us to continue to support those people. What we call labor market scarring, when people are out of work for a long period of time, the record shows empirically that their whole economic lives and, frankly, their broader lives as human beings can be damaged even permanently. So we want to avoid that. And I would say we have avoided a great deal of it. The really bad outcomes that we were concerned about a year ago have not materialized. Nonetheless, 9 or 10 million people out of work, and we need to keep supporting them and supporting the economy, and we will. be very clear on what we mean by transitory. So there's a difference between essentially a one-time increase in prices and persistent inflation. When we say inflation, that's what we mean. We mean persistent inflation that goes up by 2% or 4% or whatever it is, year after year after year. And that level of inflation tends to be dictated by underlying inflation dynamics in the economy, as opposed to things like bottlenecks. So, the nature of a bottleneck is that it will be resolved, that the supply side, if you will adapt, and that therefore whatever costs people have to bear in prices because supplies are temporarily tight as the economy reopens, those won't be repeated next year. We wouldn't think they'd be repeated. We'd think that the supply chain will adapt and become more efficient. It might take a year, but that'll happen. And so that's essentially what we're saying. Remember, Sarah, that we've had 25 years of inflation dynamics, roughly 25 years, where inflation has been low. Many advanced economies around the world, at least for the last decade, have been unable to reach 2% inflation. Some are actually fighting off disinflation. And that has been the dominant sort of set of dynamics about inflation for some decades. And now we have a situation where the economy is reopening. There'll be a surge in demand, perhaps. There will be bottlenecks, perhaps, but it seems unlikely that will change the underlying inflation psychology that has taken deep roots over the course of many, many years. So that's what we think. We think that there will be upward pressure on prices, which may be passed along to consumers in the form of price increases. We think that effect will be temporary. Now, let me say that there's no certainty in this, and if it turned out that inflation, and particularly inflation expectations, were to move up materially in a way that suggested that they were being de-anchored and that inflation might move persistently well above 2%, we would react. Of course, that would be our job. One of our two mandates is price stability. The other is maximum employment. We don't think that's the most likely outcome, but we do have the tools to deal with that outcome. We will use them to guide inflation back to 2%. If the need arises, but in the most likely case, this period will show temporarily higher prices, but not persistent inflation.
What would you do? You would raise interest rates?
That's the principal tool we have is with inflation. Yes, the traditional tool is to restrain the economy and reduce inflation that way. Again, we don't think that's the most likely outcome. That is the playbook, though. If inflation were unexpectedly, counter to our expectations, to move meaningfully above levels where we're comfortable, in particular inflation expectations. These days, people think that inflation is largely a function of what the public expects it to be. And we would be monitoring inflation expectations very carefully. If we see them moving persistently and materially above levels we're comfortable with, then we would react to that. We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort, and China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.